Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, August 8th, just after the close. This week was a heavy earnings week, had me on my toes all week. I don't know if I look as tired as I am. As far as performance and positioning and so forth, broadly speaking, in our U.S. core and U.S. ETF portfolios, led very nicely by the growth end of the market, S&P 500, VUG, which is Vanguard's growth fund. On the flip side, we marry S&P 500 with SPY-G, which is a State Street growth fund. Very solid performance. Where we saw weakness in any of the ETFs, it's really any of those ETFs that have a component of healthcare or real estate or energy, very sluggish. We've tried to keep that to a minimum, but in terms of ETFs, especially the broad ones, you're going to pick up some of that sector work. Where the real fireworks were for the week was in tactical trend. As you know, tactical trend can be in domestic equities, international equities, fixed income, commodities, currencies to some extent, although it's tricky, and can have a cash component. On the domestic equity side, we always head into earnings season knowing there'll be a little bit of volatility. We got quite a bit of it this week. One of our holdings, Vertex, VRTX, wonderful biopharm that is really the franchise player in the cystic fibrosis area. They also have a large pipeline of drugs and solutions they're working on. But one of the components, which is a pain reliever, trying to replace some of the opioid addiction in our country, didn't meet its endpoint in a certain type of pain, and stock was down 20%. So that was a nasty shot. They'll reorganize. They do have that drug on the market in another pain area. So we'll have to keep an eye on there. Important to note that in these volatile, high growth names, we're looking for 3x, 5x, 10x our investment over the course of a decade. We're always going to have to take some volatility. Importantly, we size that appropriately. So where we take a little heat on that position, which is a 2 or 3% position in tactical trend, the flip side is a name I mentioned here about a month ago, a very funny name. I added AppLovin, APP, which is in the advertising space on the internet and so forth, but most importantly, has really created a new way for clients to attack their advertising. Very AI driven. A wonderful week. Earnings were fantastic, raised guidance. From where we bought that, just a month ago, stocks up 25, 26%, 16, 17% of that this week. So we had a one that went in the bag, one that rallied. Rest of the portfolio traded pretty well. Would like to see some of this Warren Buffett worriness move off here. As you know, Buffett back 6-7 weeks ago put the timeline out for his retirement. Berkshire's been soggy, trading heavy for that period. Some of it is Mr. Buffett retiring. Some of it is investors looking at that large 300 billion plus cash positioning and feeling that Berkshire may be out of position in this market. And by the way, perhaps they are to some extent. I'm going to give you my opinion on that $300 billion plus cash position. It's my opinion that going back 12 to 18 months ago, when the timeline was put in for Warren Buffett to retire, Berkshire began to raise cash so that the new acts at Berkshire had cash to work with. The new team was not coming in fully invested and having to make decisions in the first quarter, 6-9 months of their tenure. If they came in with a fully invested portfolio and started making changes, that may have been unsettling to investors. So I think a portion of this cash raise over the last 12, 18 months was in preparation for Abel and the team to have fresh cash for fresh opportunities. And I think it'll be very interesting to see what they're geared and focused on over the next 12 months. So a little bit of good, a little bit of bad this week. Overall, solid performance, S&P up 2% or so for the week. John isn't with us this week, so I'm going to cover bonds. We gave him the week off. We've been in that scenario all year talking about the 10-year Treasury, which is the benchmark for the bond market, similar to the S&P for the equity market. That 10-year Treasury, 4 to 475. And it's been right there, 4 to 475. Maybe up a couple basis points this week. The important thing for me to keep an eye on is spreads. Remember, John and I discussed this 2-3 months ago. The spreads between investment grade credit, let's call it AA credit, and junk or high yield credit, let's call it BB plus credit, are very, very narrow. Very narrow. You're not being paid much to take that credit risk. We can look at that two ways. That tends to mean there's not much angst from investors about credit default or weakening company balance sheets. That's good. And by the way, we use that as a cross-asset indicator for equities. If there's not a lot of angst and spreads are tight, it normally means that things balance sheet-wise, net income sheet-wise, earnings-wise are going pretty well. But it's also very difficult if you're an investment grade, a pure investment grade manager, to make up for that tight spread performance. In other words, you're being paid right now, you're being paid to buy investment grade because the spread versus BB or BB plus is tight, but it's not showing up in the pricing yet. So we're an investment grade shop. We continue to be. In terms of duration, we're just a tick above benchmark. And as rates start to recede, we think we'll continue to see solid pricing out of bonds. So with that, I'll leave you for the weekend. We'll see you next Friday. I'm sure there'll be another firework or two during the week to report in. Enjoy the weekend.